Good morning, you wonderful melonheads. I hope you are well. Happy Thursday, everybody. Today is April 13th, 2023. And good news, inflation is coming down. We got producer price index today that shows more reduction in inflation. The PPI came in at 2.7% year over year. That is down sharply from the 4.9% year over year read we got last month. That's a massive drop in PPI. This is after yesterday's massive drop in CPI, or the Consumer Price Index. That was down over a whole percent from last month's number. CPI came in yesterday at 5.0. We were 6.0 last month. So inflation is coming down fast. Nitpick, that doesn't mean prices are coming down fast. All right, there was a lot of passion around that subject yesterday. A lot of people were saying, well, anybody goes to the supermarket knows prices aren't coming down. Remember, folks, inflation coming down does not mean prices coming down. Inflation coming down means prices going up slower. Big difference. Big difference. Disinflation means prices are still rising, but rising slower. Now, deflation, that means prices going down. That means negative inflation numbers. And that's the big worry right now. It feels like we're in that scene in the movie where the ship is approaching the pier and everybody's happy. Oh, look, the ship is coming in. Great. Here they come. But the ship's not slowing down. Guys, next thing you know, everybody is running for their lives as the ship smashes into the pier and destroys everything because it came in too fast and it couldn't stop in time. Or there was just nobody at the helm. Maybe that's a better metaphor, and the thing ghost ship just ran up on the beach. And it looks like right now inflation may be coming down so fast and the market is quick to celebrate. Oh, yay, the Fed pivot is here. Lower rates are on the horizon. I'm not so sure this is a good thing. Guys, we're only a month removed from the second and third largest bank failures in United States history and a GSIB bank failing in Europe. We dodged a black swan credit event by a couple of hours last month, and the market's just like, la-di-da, up we go. Great, we defeated inflation. Victory is ours, onward and upward to new highs. Be careful what you wish for, guys. If we're not careful, if these inflation prints keep falling so fast, they're going to go way past zero into negative, and this could be predicting a massive deflationary black swan credit event, one that we very narrowly avoided. You could argue we didn't even avoid it last month. It could be more of it on the horizon. We're already starting to see signs of it. And so with that, we are going to shrink my big million of a head, and let's see what's going on in markets this morning. Stocks currently celebrating the PPI report, up 13 points this morning, or about 0.31% at 4,104. The Dow is up 52 points, or 0.15% at 33,698. And the NASDAQ, sure, why not, up 84 points, or 0.71%. So the market is signaling the all clear, low inflation, good for stocks. The DXY, though, watch that DXY, folks, currently at 101.02. Down another 48 basis points right now. And this is the DXY is predicting a more dovish Fed in the future. The dollar is falling in value because they're predicting lower rates and easier availability of dollars on the horizon. And check out this chart. I showed this one yesterday on my live stream, folks. Watch this head and shoulders pattern on the DXY. Watch out for this, man, because we just broke below the neckline today. We are down at below this 101.5 roughly number, which is where the neckline on this chart was. And if this DXY pattern confirms, if we break below and then come up, retest, and bounce lower again, I've got a target of about 88 for the Dixie. That's rocket fuel for precious metals if that happens, but that's also very bullish for stocks, unless, of course, we don't get that black swan event. See, that's the big thing. Can we get a Fed pivot? Can we get the lower rates by the end of this year like the market is predicting without blowing everything up? I'm not so sure that's a given. So all things being equal right now, the dollar is headed for a big tick down. But what could make the dollar go down so far? Well, maybe the Fed taking some kind of drastic action like printing trillions of dollars or lowering rates to zero. Well, why would the Fed do that? Probably because everything is on fire. So that's not necessarily a good thing. Looking over at the bond market right now, we have got yields are lower almost across the board right now. The 10-year Treasury yield is at 3.39, down about 3 basis points, and it looks like the big mover is the 3-year, currently at 3.66, down about 5 basis points. But the big news today is in the commodity space. Check out those precious metals right now. Gold at 2,056, up another 32 bucks today, or a point and a half. And we've got silver, my favorite of the shinies, up 51 cents, a whole 2% at 25.97. Are we going to see a 26 handle in silver today? I'd love to see it. So let's look at the charts in the precious metals real quick. Again, be careful here, guys. That's all I'm going to say. Be careful. All right, first of all, gold. Looking at this one, this is going all the way back to about 2020, right? We had that monster bull run in the summer of 2020. Again, that was the market seeing the lower rates, anticipating inflation. The price of gold rallies, anticipating inflation. And then, of course, it sold off after all of the central bank shenanigans and everything else. We came back up to that level just after the silver squeeze. And then in March in 2020, we went just over 2,000 again, but we bounced off of that double top pattern. Now we're approaching that level again. All right. I'm still a little skittish. Look, the RSI in gold, it's getting up there. It's over 60, approaching 70. Gold doesn't usually get that high in the RSI. What I would like to see is I'd like to see this break above this previous high, come down and retest it, and then go onward and upward to new highs from there. I'm not so sure we're going to necessarily get that, guys. It may not happen. If we get that deflationary credit event, if we get more bank failures, if credit conditions seize up, if banks stop lending, which we're already starting to see, I'm going to show that in a little bit, then that means gold prices will head lower. All right. But for right now, gold prices are anticipating lower rates on the horizon. So they're saying higher, onward and upward. Now, silver's kind of showing the same thing. Not quite as high, not approaching its previous highs like gold is, but definitely a breakout. I've seen some guys draw similar charts, and they put their resistance line at a little bit of a lower point. I'm not the best chartist in the world, so there's better chartists than me. But a couple of things that worry me about this chart. Check out the RSI on silver right now, getting way overheated, all the way up here at 78. Folks, you got to go way back to find the silver relative strength anywhere near that level. That's a measure of the momentum of the move. Silver is going to run out of gas soon, all right? It's bound to happen. I don't want to poo-poo the rally here, guys, but it's bound to happen. Now, here's the question. When silver does finally take a breather, does it trade sideways? Does it come down and retest this level? Does it bounce off of that level and head higher? Or does it break down and we get that price smash straight down like we've seen before? I don't know. But again, the big difference is going to be, does that credit event happen? Do we get that massive deflationary event that it looks like we're heading towards or not? If we can get the Fed pivot and the lower rates without everything breaking, then silver and gold go higher. If we get those lower rates because of some kind of liquidity event, some kind of big bank failure, some big deflationary event, then metals will go lower on that news. That's the dichotomy that we're currently looking at. All right, let's look at a couple things over here in the producer price index. And this is the month over month number just came in. Now, producer price index, this is the cost to make stuff, right? This is not the cost at the store. So this kind of front runs CPI. Producer price index for final demand in the U.S. fell by 0.5% in the month of March of 2023. That is the biggest decline since April of 2020 compared to forecasts of a flat reading. So the cost to make stuff went down by 0.5% last month. That's deflation, folks. Now, the cost to buy the finished product did not go down. This is the price the producers are paying is going down. Why? Because manufacturing is slowing, because there's less demand. New orders are slowing down. We've talked all about these PMI numbers and these manufacturing indexes. They're all showing big slowdowns in industrial activity. It's starting to reflect in the producer prices. All right, so look at that big drift down, folks, in the month over month number. We went from 0.4% up a few months ago to flat last month, and now negative 0.5%. All right, so these month over month numbers, they're showing prices starting to fall. All right? It's still not reflected at the store. I know life is still getting more expensive for all of you, all right? It's the same thing for me. But the data says what it is. And look, I get that the government fudges the data points and that there's, you have to factor that in, but we can only play the hand we're dealt. We can only go by what we have. And at the very least, the trend is showing down. And looking at the year over year number, this is the one that really shows the bigger jump, in my opinion. The producer price index and final demand in the United States increased by 2.7% from a year earlier. And that is a big step change down from the 4.9% we saw last month. Right? So couple that with a full 1% drop in the CPI, the consumer price index. Inflation is falling very fast right now. Price is not falling very fast yet, but inflation is falling very fast. And this is the M2SL, the money supply. All right, this is all the checking accounts, all the CDs, all the money markets in the United States. Look, folks, the supply of money is starting to fall. Zoom in on these most recent charts here, right? Look at this. The supply of money, there it is, clear as day. It is shrinking right now. And we live in a debt-based system, a system that has so much rot and so much excess. It's dependent on easy money for its very survival. When you take away the easy money and then you start shrinking the money supply, the odds of something really bad, like, oh, I don't know, say Silicon Valley Bank failing or Credit Suisse failing, the odds become very likely. So this is a very dangerous chart here. There's a lot of risk involved in this chart here, folks. The money supply has not shrunk in the United States since 1930. Not a period you'd care to repeat, folks. All right. Now, the other thing to keep in mind, as this is happening, as the Fed is rising rates, as banks are under pressure, banks are playing defense and they're not writing as many loans. And that means the contraction in the money supply could accelerate from here. Check out this chart. Small business credit. The percentage of firms that are reporting as credit is getting harder to find, right? They're polling business owners. They're asking people, hey, how hard is it for you to get a loan if you need one? The number of people that are reporting difficulty getting a loan, and this is going all the way back to 1988, is rising sharply. The banks are tightening their lending, and that is where money is really created. Banks loaning money into existence is how the money supplies. And right now, the banks are saying, I just watched SVB fail. I just watched Signature Bank fail. I watched Credit Suisse go down. I'm going to be careful. I'm going to play my cards close here. I'm not going to make any risky loans, and we're going to see what happens. Well, when that happens, money gets harder to come by. Interest rates go higher. You start to get more defaults. More businesses go under. More layoffs. More houses hit the market. You can see where it goes from here. And this number right now, the number of people reporting difficulty getting a loan is rising at the fastest rate since, well, the GFC. And it's already higher than during the dot-com bubble. So this is happening very fast, folks. And again, be careful what you wish for. Everybody wants an end to inflation. But right now, inflation is coming down so fast, it may keep going. It may blow past zero. It may go deeply negative. And then we've got a whole new set of problems to deal with. All right, elsewhere in markets, another story that's important to keep an eye on. Warren Buffett just dumped his stake in Taiwan Semiconductor. Better pay attention to that one, folks. This story came out yesterday. Warren Buffett says threat of war was a consideration in his decision to dump the bulk of his $4 billion stake in chip giant Taiwan Semiconductor. Now, he tried to say something like there was seismic risk. He said, yeah, okay, he dumped stock in the biggest manufacturer of chips in the biggest geopolitical hotbed in the world because he was worried about an earthquake. That's why he dumped Taiwan Semiconductor. Do you believe that? Okay. Well, maybe this threat of an earthquake is very real. And maybe that's why Senator Tommy Tuberville just disclosed that he purchased put options in Taiwan Semiconductor. Whoops. By the way, Senator Tuberville, he sits on the Senate Armed Services Committee. Maybe he thinks there's an earthquake coming too. Better pay attention to this one, guys. When senators on the Senate Armed Services Committee are dumping stock in Taiwan Semiconductor, right as the Oracle of Omaha, one of the most rich and powerful men in the world, the guy who has a knack for seeing things coming, also sells Taiwan Semiconductor. Pay attention to that little island in the South China Sea, folks. This is not a good sign when I see senators on the Senate Armed Services Committee and the Oracle of Omaha dumping their stock at the same time. Not good. Also, folks, I saw this article right now and I just couldn't help but shake my head when I saw this one. It actually came out last night. FTX is considering using creditor money to restart their crypto exchange. What? Show of hands. Anybody who wants to do business with FTX? Who wants to sign up for a new FTX account? Anybody? Some of you guys in the back? No? No one? No one? Of course not. It's one of the biggest frauds in history. What are they thinking? The exchange would require a significant amount of cash that they owe to the people that Sam Bankman-Fried robbed, I might remind you. But no, they want to use that cash to start their business up again. What? Discussions about the exchange restart are still in the early stages. And folks, look at what happened yesterday. This is FTX token, FTT. All right, look, guys, we need to talk. We tell me the bottom isn't in without actually telling me. Look at FTT token. All right, this is a altcoin that was proven to be a Ponzi scheme or a flywheel, depending on how you want to talk it, right? The guy openly joked about what a fraud his token was and how he was using it as his own personal slush fund. And there's a rumor that FTX might start up business again yesterday. And all of a sudden, this token that should have gone to zero back in November is doubling in value. Guys, I know melon heads were not involved in this trade yesterday, right? Right? Come on, guys. Look, okay, whatever. It's an interesting story. It gives me something to talk about on the air, but let's just say I won't be putting any money into FTX token anytime soon. So long story short, guys, watch out for this deflation story. I know prices aren't going down for any of you guys. The finished prices aren't going down. But once deflation gets here, it's hard to get out of that, all right? Deflation sounds like a great idea. The price is life getting cheaper. It sounds like a good idea on paper, but when it finally does arrive, usually it's because everybody lost their job, nobody can afford anything, and prices are going down because the companies have to lower their prices in order to get any sales. That is, the companies that are even left after everybody goes out of business. And inflation is falling so fast right now, it's time we stop and look like, uh-oh, guys, it's not slowing down. The ship is still steaming towards us. And they're saying there's a 1-year delay between the rate hike and actually feeling the effects in the economy. Well, remember, it was only 13 months ago that we got our first 25 basis point rate hike. And remember last summer, we had 3 consecutive 75 basis point rate hikes. What was it, June, August, and September? We had 75 basis point rate hikes. So what's going to happen when those 75 bip hikes, when they get their first birthday? Right? We saw when the 25 basis point, when that first rate hike turned 1 year old, we had 3 bank failures back to back inside of a week. What happens when those 75 basis point hikes turn a year old? All right, so that's why I'm not piling into precious metals right now. I'm excited to see the metals rally. I love to see it. Congratulations, stackers. But I'm not going out on leverage. I'm not FOMOing into this thing because gold and silver will rise on these lower interest rates that the market sees coming, so long as we don't spill over into deflation. And if we do, you don't want to be on leverage buying precious metals when that happens. And I just want to say thank you very much to Nashville Pasta Man. Appreciate the super chat, sir, and the support of the channel. He says, "You are my financial spirit animal." Mish, not so much. Mish. Mish is Johnny Five. He is the number crunching, data hungry analyst. I'm telling you, every channel needs a Mish, Nashville. Every channel needs a Mish. So thank you very much for the super chat for the chat and the support of the channel. I appreciate it very much. What spirit animal, by the way? What kind of animal am I? Hopefully it's something really cool. And thank you again, Mish, for everything you do for the channel, sir. I appreciate that very much. And I think that was the only super. Let me make sure I didn't miss anybody here. I don't want to miss you guys. There is a lot going on in the chat. All right, that was everybody. So long story short, guys, careful what you wish for. Deflation may be coming. And that black swan, that credit event happening, that's going to be whether or not metals heads higher or metals fall, right? If we get big bank failures, if we get a big deflationary credit crunch, metals goes lower. It's going to happen, right? If we don't, if somehow we engineer the soft landing, rates start lowering again, and we don't have massive defaults or massive bank failures, then metals is going to go higher. Looking at the commercial real estate market, I'm leaning towards the first one. All right, guys, I want to say thank you very much for the super chats. Thank you to my Patreon supporters for everything you guys do for the channel. Had a good time talking to you guys yesterday. Hi, Mom. Hi, Dad. I love you guys. And until next time, live small and dream big.